Thanks for joining me today to have a look at Reinet. So I'm going to start off by just going through a brief overview of the business. Then I'm going to have a look at our recommendation on the company, then the financial review, and then lastly I'm going to have a look at their portfolio. So Reinet is an investment holding company. This slide shows the investment portfolio. Just keep in mind that the investment portfolio is not the only part of their net asset value or NAV, although it is the largest, but the NAV also includes, your cash and debt, which is not shown on the slide. So British American Tobacco, or BATS for short, is their largest investment. It makes up 62% of the portfolio. Most of you are probably very familiar with the company or have at least heard of it. It's listed both locally on the JSE and in London. So their business spans across the globe and includes top brands such as Kent, Daniel, and Lucky Strike, to name a few. A big focus area for them is on their next generation products, which is actually, well, it's essentially your e-cigarettes and other innovative devices. Their second largest investment is the Pension Insurance Corporation. This business operates in the UK. So what they do is provide risk management solutions to defined benefit pension plans. Just for those who don't know what a defined benefit pension is, it's when your employer is responsible for your pension. So an employee, so the employer will go and invest in some assets, typically more bonds and equity, and then these assets will be used to fund their employees' retirement. The problem with this is that if the company doesn't have sufficient investments to cover the retirement payouts when due, they then run into a funding deficit. So this becomes a risk to the company. There has been a shift away from the use of defined benefit plans towards defined contribution plans. In this case, the company may contribute to a pension fund that is managed by a third party. This would typically be in life insurance or an asset management business. This way, the employer does not assume the responsibility for ensuring their employees' retirement, and therefore they don't run into a deficit, and it's a less risky approach. So Pension Corp provides services for companies to reduce this risk. Private equity and related partnerships makes up 13% of the investment portfolio. This consists of many different investments. The investments are also quite diverse across geographies, strategies, and asset classes. The other investments include Spider Gold Shares, which is an ETF, diamond interests, investments into US land development and mortgages, as well as some others. But collectively, these investments only make up 4% of their portfolio, so it's quite small. Okay, now on to our recommendation. So we do believe that the valuation for Reinet is quite attractive. We recommend an overweight position with a recommended portfolio exposure of up to 5.82%, being a 5% active weight. It is an attractive entry point into BATS. It's trading at a 38% discount to our sum of the parts valuation. This valuation takes into account what we believe the fair value for BATS is. Just looking at Pension Corp, there are strong catalysts for growth in this business. As I just mentioned, the defined benefits add risk to employers, and the incentive for these companies to de-risk their balance sheets are growing. Increasing regulatory complexity is one of these incentives. This comes with additional compliance costs. Also, UK bond yields are at very low levels, so this does make them, quite costly investments. Just important to note here, because BATS is such a large investment in Reinet's portfolio, exchange rate movements and the movements in BATS share price will dominate the movement in Reinet's share price. Okay, now onto the financial review. Because Reinet is an investment holding company, we're not going to look at the typical revenue and profits, but rather at the intrinsic net asset value, or NAV. This is a better measure of their performance. So NAV dropped by 10% to 5.4 billion euro. Just looking at the chart, you can clearly see that the decline in BATS share price was the main reason for the decrease in net asset value. This was because the FDA, which is the US Food and Drug Administration, announced plans to implement regulations that limits the amount of nicotine in tobacco products to non-addictive levels. So this obviously has a negative effect on the prospects for BATS. The drop in BAT's share price was, however, somewhat offset by a higher value for Pension Corp, as well as lower borrowings, and this was due to the weakening of the pound against the euro. On a per share basis, intrinsic NAV was 10% lower at €27.55, and they did not declare an interim dividend, but this is in line with their dividend policy. Now looking at their portfolio, I'm going to start off with British American Tobacco. So Reinet's NAV and BAT was 15% lower than they reported at the end of the 2017 financial year, which was at the end of March. Over the same period, BAT's share price dropped by 11.8% in London, and this was amplified by the weakening of the pound against the euro. Their effective interest in BAT dropped to just below 3% from 3.7%, and this was because they issued shares to acquire Reinet American. They do believe, that they can extract synergies through this acquisition, and they also think that it's going to help drive market share gains, particularly in their next generation products. Okay, looking at Pension Insurance Corporation, intrinsic value increased by 2.6%. This is roughly in line with the growth in embedded value of 2.2%. Management's approach to valuing this business is to evaluate at a peer group price to embedded value multiple, and then they apply a 10% discount for the lack of liquidity, obviously because this is not a listed business. Just looking at their underlying performance, they did have a very strong first half. New business premiums more than doubled to £1.9 billion. A total of 10 plans were insured in the 6 months compared to only 2 in the comparable period. And this really reflects the conversion of a strong pipeline that they saw coming into the 2018 financial year. So the effect of this new business is seen in their financial investments. This increased by 7% to £24 billion. The expectation is that the strong demand will continue. Management has indicated that there's currently around £12 billion in pension liabilities that are looking to be insured in the market, and they did raise additional capital in the business to support this higher demand. Okay, so lastly, just looking at their private equity and related partnerships. Total NAV across all the funds was relatively stable at €779 million. This consists of Trilantic Capital Partners, which focuses on private equity opportunities in North America and Eastern Europe. Here, NAV increased by 6% to €214 million. The contribution to NAV from the Asian focus funds was flat. NAV from the more diverse specialized funds dropped by 3% to €347 million. And then lastly, the 36 South macro volatility funds saw NAV drop by 10% to €44 million. Before I conclude, can you please just take note of the disclaimer? Also, if you'd like to submit a question, please do so now. I'm not going to get back to you live during the session, but we'll respond to you via mail. And that concludes this webinar. Thank you very much for listening, and have a good weekend.